G'day expats. Today we're just doing another Ask an Expert webinar series, and the topic of today is 10 things expats need to know about getting a mortgage in Australia. Today I'm joined with Jeremy Harper from Hfinance, who is an expat mortgage broker specialist. As we progress through, we're going to touch base on these different things as well as a bit on the mortgage process and just key items that you really need to be aware of, especially when you're trying to obtain a mortgage from a foreign country. So as we progress through now, just going to touch base on a short disclaimer. Obviously, anything that you hear in this presentation is not personal advice. Please do not take it as such. It's all general in nature, mainly informative and educational. Obviously, if you need a mortgage, feel free to reach out. At the end of the slide, Jeremy's details will come through, but make sure you always seek advice from a professional that's qualified in that specific area. So moving through now, we're going to touch base on who is Atlas Wealth. So Atlas Wealth Management, we're a leading provider of Australian expat financial advice and have won multiple domestic and international awards for the services that we provide to Australian expats overseas. We've currently got, I believe, 28 countries. So we've got clients in over 28 countries now, all of which receive financial advice from us in an ongoing manner. We are the global financial advisors to Australian expats. I'm joined with today my co-host, Jeremy. Jeremy, if you can just sort of raise your arm and say hello. There we go.
Hey James, thanks for having me.
No worries, mate. So obviously, Jeremy Harper of Hfinance. Hfinance started back in 2015. Jeremy's obviously the managing director of Hfinance and is also a chartered accountant. I might just pause there. How long were you a chartered accountant for, Jeremy?
So I started when I finished university in Melbourne, started working for mid-tier in tax and advisory for a couple of years, and then started working in industry, working for a company doing some management accounting, and then decided to jump into the mortgage brokering game. Really saw a need to, well, I enjoyed working with clients and obviously working in industry. I missed that client interaction, and I saw a bit of a gap there in terms of financial literacy and helping out people with their mortgages.
Yeah, that's right. And I suppose, you focus on a particular niche. There's a big need for it, a big drive for it. It's a massive, I suppose, market, and there's not too many people that focus on assisting Australian expats. It's sort of a bit of a grey area, I imagine, for a lot of brokers because they just don't know how to treat expats. And I see here also, you're previously an expat living in New York with your wife. Is that right?
Yeah, so lived in Upper East Side in Manhattan for a couple of years. So understand the life of an Australian expat, being one myself, excuse me. And then previously we've moved back to Sydney. So, I understand filing 2 types of tax returns and opening up new bank accounts and just some of the challenges that come with living on the other side of the globe, with the time zone and the different currencies. So, yes, I understand how the expat sort of life works a little bit.
Yeah, absolutely, and I think you've probably you got a bit maybe over dealing with the IRS as well. I mean, I always term them as the worst taxation authority in the world, and they are. No one's going to come close to them. But I mean, more on that. You're now back. You're living in Sydney, aren't you?
Yes. So I got living in inner Sydney, and so continue doing the expat mortgage piece, which has been great. So just a little bit about how the Australian mortgage broking works. I've got accreditations with about 35 Australian lenders, up from your big banks, middle tier, and some smaller players. Even we've got a new digital bank that just came on board, so that's quite exciting. So it gives clients access to lots of options. And then on that panel, there's probably about a dozen lenders that come in and out of the expat space when we're using foreign income. Sometimes policy will say, yes, we're playing in that space. Sometimes they'll pull out just depending on their credit appetite. So for me, it's always important to give expats, a number of options that are suitable for their circumstances.
Yeah, of course. I mean, when I saw that, you have 12 plus lenders on a panel that are happy lending to expats, I was actually quite shocked, to be honest. I didn't think there'd be that many. I thought it'd be a lot less. And I originally had the interpretation that the big four banks didn't like expats. So the fact that, there are some that still are happy lending to them at, still good rates as well, I was very surprised. So it just goes to show that, it pays to obviously speak to a specialist in that area rather than just obviously engaging your big four bank and sort of accepting with what they're going to give you.
Yeah, yep.
Absolutely. Okay, well, let's transition over now to the next slide. Let's talk a bit before we dive into more about just the mortgage process. For people that haven't got a mortgage before and are considering sending funds home to invest back in Australia and, get that investment property or that future main residence, how does the mortgage process look? You've outlined it here, but yeah, walk us through it.
Sure. So I guess the first step is obviously a mortgage meeting, give a fact-find discovery. Obviously being an expat, that's going to be a video conference or a phone call scheduled, depending on time zones. And really from that initial meeting, it's really understanding, okay, what are their goals, short-term, long-term, what do they actually want to achieve with a mortgage, and then understanding a little bit about themselves. So what sort of currency are they earning, where are they living, how they earning income, is it PAYG or W-2, is there commission bonus income that we need to think about, or are they self-employed, or are they a contractor role living overseas? So get a bit of an understanding about that. And then also on their sort of expense side, how are they living? Do they have a mortgage overseas? Are they renting? Are they packaged up with work where they're providing rental assistance at this stage? And then do they have kids, or is it just themselves individually, dual application? So getting all that information up front. And then that takes me to sort of the second step, which is I'll typically go away offline, do what I call a credit assessment. So really crunch the numbers back in the back end and go, okay, this is where you sit from a mortgage point of view. These are kind of roughly where your options are. Maybe they're ready to go ahead with looking at some products, or maybe it could be, let's put this on hold and you need to do a few things. Maybe you need to pay off some credit card debt abroad or close off some credit cards. Come back to me in a couple of months' time, or maybe even come back 6 months' time when you've saved up a little bit more of the deposit, and then we can go ahead and actually chat about product and different lending options.
Yeah, of course. And I mean, you go.
Yeah, I was going to say, if, which takes to step 3, if they're ready for, okay, we need to go ahead with looking at applications. So then I'll put together a couple of different products or a couple of different lenders on my panel that will suit what they're trying to achieve. And part of that is actually talking about product as well, which we'll touch on a bit later, but going through things like offset accounts, redraw accounts, if the clients are looking at principal and interest repayments versus interest only, or looking at variable loans versus fixed. So there's quite a few different products.
All those crucial features of, I suppose, a mortgage, and what's suitable.
Correct. And part of that product recommendation will come back to what they'd like. So, for example, if a client's after an offset account, some of those lenders on my panel don't actually offer offset accounts to expats. So I'll have to strike them off my recommendations. Some won't allow interest-only repayments. So again, it will sort of narrow down how many options available. And we'll go through sort of what that would look like in terms of repayments, fees, and interest expenses.
Yep. Okay. And as we move through, obviously, you've got the pre-approval, which is that just essentially saying this is how much you can borrow based on, with these lenders?
Correct. So if someone's looking to buy, an investment property and they want to buy something up to, let's say, 500,000 Australian dollars, we'll get them a pre-approval for, say, an 80% finance, and we'll get that submitted. That means it'll give them confidence that that's valid for 3 months, and they can go to market and then start looking at property, and which takes you to sort of step 6, because a lot of people will start looking at property online, get really excited, and then work backwards to see how much they can afford. I always say, let's get the pre-approval first. So you actually understand, okay, the bank will lend me for a $500,000 purchase, then they can go start searching for property.
Yeah, okay. So we can sort of get a bit excited as well,
Correct.
Find that property and then go, okay, crap, got to work out how we can actually buy it now. And sometimes maybe you can't, depending on your circumstances, which is unfortunate. And then obviously, as you mentioned there, locate the property, find the property after your pre-approval, and then formal approval, going through the process of buying and matching and putting down those funds.
Yeah, and so I guess the things to consider around formal approval and settlement, and this is really conversation to have with your conveyancer or lawyer that helps you out. But, I always recommend trying to negotiate sort of a 45-day settlement so we can arrange the loan documents, give yourselves a bit more time. Again, depending on the lender, you might need to receipt the loan documents, book in a time with the consulate to get it witnessed. So that will add a few more days to the settlement process. Then you'll need to mail them back to Australia. So all those can sort of be, 5-10 working days. Particularly depends on where you're located and you need to make an appointment. So there's a little bit to work around getting the loan ready for settlement. Obviously, if you get those affairs in order quickly and the bank's ready to settle, well, you can bring forward the settlement as well. But always negotiate for a longer settlement with the idea of trying to get it arranged in time.
Yeah, I imagine not too many, even conveyancers, wouldn't think about maybe just extending that sort of time frame because you've got to deal with international post, getting things over to the clients via FedEx or whatever it might be.
And it's also allowing for things like, and I've seen it, docs go out, the bank hasn't included the car park title on the title, so they had to reissue loan documents, or they've misspelt the borrower's name, so we can't get to settlement. So there's always those little things that can pop up. So just giving a little bit additional time.
Yeah, bit of breathing room, and then obviously settlement takes place as everything is more formalised. So no, that's good. That's been a great outlay of the mortgage process, and I think a crucial factor is just as settlement comes up, giving yourself that time, giving yourself that cushion, because depending on where you are, sometimes international mail isn't the most secure form, especially throughout some of the Southeast Asian countries. You might not get it, to be honest. So anyway, I've seen that happen with a few clients with a few different bits and pieces. But let's move on now. Topic number one, foreign salary. So, if we're obviously living overseas in another country, how does an Australian lender view a foreign salary? Now, as an example, to give a bit of background, some clients might be in a situation where they are, they're on a base salary, but they're also receiving a lot of these allowances. So how does, I suppose, a lender treat a foreign salary, especially from maybe, as the next point mentions, converting it back to Australian dollars and those sort of things?
Yeah, so look, obviously you've got their base and allowances and bonuses we could also put into the mix there as well. So I guess the first thing is banks have what you call, generally speaking, gold and silver tier currency. So US dollars is your gold standard, your pounds, your euros, where it's a bit more of a reliable currency. So generally the bank will convert that from the foreign currency to Australian dollars at spot rate and generally shave 20% off. So if it's 100,000, they'll take it back just for FX purposes. And then once they've shaded that, we can use that for servicing. So generally with your base allowance, that's all that needs to be done from a servicing point of view. But when you talk about allowances, some lenders get a little bit funny. Some are happy to take another 20% off for shading. Some will only take half, and some will actually not use that as acceptable income. Because I guess they don't view it as a reliable source of income compared to a base salary. Now, even though part of the process will present the lender, the contract of employment, so you can see clearly outlined, here's my base and here's my allowances that are part of my employment package. Regardless, they can still be a little bit sort of thingy about using all the allowances for income. So that's just something as part of my recommendations, I'll weigh up, okay, do we need the allowances and bonus income for servicing? If so, that might steer us towards a couple of different lenders who are more open to using that type of income. If not, and we can just service off the base income, that's fine. If the client is getting paid in a currency outside of USD, so you've got the AED here, again, some lenders will just have a not acceptable currency on their list. So you could service with that lender, but because you're getting paid AED, dirhams, they just won't accept that at all. So that's not a deal for that lender. And that you'll find that with some of the sort of more unique currencies that I see as well. Some banks just go, no, sorry, that's not acceptable. We can't help that client at all. Whereas some lenders have a range, like a big list of currency they'll accept. So the more unique the currency you get paid in, potentially the harder it will be to get a loan financed. That's something would work through. And then finally, on your last point, most of the lenders I've got will apply the Australian tax rate for servicing purposes. So you'll find that okay, you're in a tax-free jurisdiction, you may be in the Middle East or somewhere in Asia where you're paying very low tax or no tax,
Yep.
they'll still apply the Australian tax rate for servicing. So that will obviously decrease your borrowing capacity. But we do
Yeah.
have some lenders
Yep.
that will look at, okay, we're going to do the servicing based on your net of tax income. So if you're paying very little tax where you're living, they will actually accept that and apply as a tax-free income for servicing. So you're going to have these big differences in borrowing capacity between the lenders.
Yeah, I mean, it's a real shame that that's how some of the lenders treat it, because I mean, as an example, if you touch base back on their allowances, you might have say someone that, their base salary might be 100,000, but they get an additional $150,000 in allowances dumped on them. That might be for schooling, living allowances, car allowance, but they're not using it, but they still get it paid to them. But the lender doesn't care. And then another important factor that you make there is, if I'm in a tax-free sort of income area, which is common with the Middle East, they're still going to treat it like you're employed in Australia. And I can think of common cases like that. There's quite a few nurses that obviously live and work over in the UAE, and they're still on somewhat equivalent salaries here, maybe 90,000, 100,000 US dollars, but it's all tax-free. They've got a good asset base, a good deposit, but the the lender, depending on the lender policy, is going to look at them and say, sorry, we actually can't lend to you, even though you're on this great tax-free income, which is tied to the US dollar. So that's a real shame. Yeah, but I mean, that's very interesting, especially the fact that I didn't realize that lenders have different policies around currencies in terms of their tiers. You mentioned the gold tier being the US dollar. I can understand that, but then there's obviously a tier where there's exotic currencies, much probably like, I can think probably, again, through the Middle East, all the reals, all those different ones where they're probably just like, it's too uncertain.
Yeah. And look, that depends on the individual bank's policy. So that's just, for my role, it's really about finding a bank that will accept that currency and support that on the application.
Yep. Yeah, okay. No, it makes sense. All right, let's carry forward onto the next slide, which is worldwide assets. So, if I'm coming back to Australia or I'm looking to purchase in Australia, how does a lender view my worldwide assets? And an example of that might be, I've got a property in the US that's, almost paid off. Do they take that into account in terms of my worldwide assets at all?
So part of the application, the banks are really focused on funds to complete. So that could be assets, could be cash, shares, or liquid assets that are in Australia, which is quite easy to verify. We print out a bank statement with their name, say, yes, they've got X amount in the Australian bank. But if they've got cash sitting overseas, shares, that will get converted sort of at a spot rate. And we could say, okay, we've got $100,000 sitting in a US bank account. It's $140,000 Australian. We'll print that out with their name. Now, at the application stage, it doesn't need to be physically put into the Australian bank account. We just need to present to the lender and say, okay, at settlement, here's our funds we have overseas. That will be in Australia. And then the credit team will look at that coming across. When you're talking about property, that's a little bit different because it's not a liquid asset. You can certainly would list it down as an asset on the application to show, here's my Australian and international assets. In terms of using as funds for the purchase of the Australian property, that's going to be a little bit tricky because, unless you've got a contract to sell it abroad, but if you're trying to hold on to it, you'd really have to show that you've got potentially a mortgage against it to release the equity. Let's say it's a US property, you've got a US mortgage approved, and we've got a line of credit that we can draw down, and we're going to use those funds to purchase in Australia. But in saying that, we just have to, if you do have a mortgage on top of that to get the equity out, we'd have to factor in that US mortgage on the Australian application as well for servicing.
Okay. I mean, I've got a bit of an ad hoc question to this point, and it's mainly around when a client is, coming up to the stage of expatriating, heading over to another country. Do you often find a case where clients might refinance on an Australian property to pull out equity, to take that equity that as maybe a deposit to another country to buy a house?
Yes. The challenge with that is when you do the application, you have to say, is there going to be any adverse changes to the client's circumstances in the near future? So obviously, if that's the case, we just have to map out, okay, well, yes, they're going to take out some equity on the Australian property to buy when they move overseas, but we'd also have to give the bank comfort that, okay, you're going to have a job lined up overseas, which obviously you will because you move overseas, and that you can service the you know, if you're going to take a mortgage in America to finish off that purchase, then obviously you can service the new loan, the refinance loan in Australia, plus the new loan under the new income.
Yeah, okay. I mean, another point here is, you know, you mentioned there, you know, looking at my assets when held in multiple currencies. And so it sounds like they're just taking the spot rate, but as you said, they shave off the 20%. Is that right? There's a margin of error that they factor in?
Well, the 20% shadings for servicing.
Okay, yep.
So that's to be able to service the proposed loan. But in terms of presenting the personal asset liability statement to the bank, we can just do a conversion at spot rate, because what you're telling the bank is you're saying, okay, I've got $100,000 in the US, but it's actually worth 144 in Australian dollars. And obviously the application we present to the bank in Australia, everything is listed in AUD values.
Yep. Okay. No, lovely. No, that makes it clear. All right. Well, let's move on now to the next slide, number 3, which is talking about deposit requirements. Now, you know, first sort of point that here we can see, do I require more cash or other assets as an expat to get a mortgage? I think that question that I've sort of framed there is mainly around, you know, am I seen as an additional risk, and therefore do I need more money to get that loan? Do I need a higher percentage deposit?
Yeah. So generally speaking, most of the bank's policy is all of them will allow a 30% deposit, and then 20% deposit will be allowable with a number of lenders as well. So that the biggest restriction is, being an expat, you won't be able to go into LMI, which is lender's mortgage insurance. So if I live in Australia and I'm residing in Australia and I want to buy an investment property or even a property to live in, I can go to a bank and go up to 95%. So I could have a 5% deposit. I'll pay mortgage insurance to that lender for that low deposit. So that's the big difference. That's not allowable at all with any lenders. So you'll need a 20 or 30% deposit. But in saying that, it doesn't just have to be cash. If the expat has existing property in Australia that they've got equity in, you can release the equity on that property to buy another Australian property.
Yeah, okay. No, that's an important point. I think before we started this webinar, you were telling me about guarantors, how, you know, an expat living overseas might have, you know, their parents living back here. Their parents have obviously paid off their loan. They're retired. How does that operate with maybe using a parent as a guarantor for an expat property purchase?
Yeah, so provide the guarantors is still living in Australia and they've got a suitable property that they can use as security, the bank could potentially help them out in terms of using that security, maybe taking a 10 or a 20% secured charge or limited guarantee against that property, and using that as the deposit for the purchase. So the borrowers, the expats overseas, they would be assessed on servicing the 80% loan, which is secured against the purchase, plus the 10 or 20% loan secured against mum or dad's property. And the two loan splits would then have to demonstrate you could service on the overseas income. So that is definitely possible. It just, the biggest restriction is the guarantors have to be living in Australia. So mum and dad can't retire in Greece or on the beaches in Italy. That just wouldn't fly with the banks.
Yeah, if only. But yeah, okay, that's an important point you make there about the lender's mortgage insurance, how most lenders, or you know, they don't want that sort of factored into the equation. They want to make sure you've got that capital for that minimum 20% initially, or in this case, as an example, a guarantor. So that's I think a big takeaway to take away from that, especially from a deposit requirement point of view. The next point, number 4, as we move forward, is, you know, purchasing with a foreign citizen. So I'll, you know, give you a bit of background. You know, usually when we go on these expat roles, if we're single, we might go to another country and we might meet our new partner. You know, we might meet our new life partner, and we've saved up over a few years, whether we're living, you know, UK, New York, overseas in Dubai, wherever it might be, and we've sort of built up a large deposit that we want to send back to Australia to purchase a house. Now, obviously, my partner's a foreign citizen, they're a foreign resident. So, you know, can I actually obtain a mortgage with my partner, you know, that's not an Australian citizen, nor have they ever been a permanent resident?
Yeah, so I guess there's two things to think about. There's one is who's going to be on the title. So if you want the Australian citizen and the non-resident to be on the title, there's one thing we'd need to consider, which is the FIRB, which is a government agency. They brought in a bunch of rules a couple of years ago around non-residents purchasing or restricting or slowing down the purchasing of Australian property. So if you go on that website, you can see there's exemptions around if you're a spouse of an Australian citizen, you may be exempt from having to pay the additional surcharge for purchasing as a foreign resident. So
and
that's
that surcharge you mentioned, that's on the stamp duty, isn't it?
correct. Yeah. So it's
Yep.
additional. Look, I think it comes down to state by state, but it can be anywhere up to an additional 5-6% on top of your regular stamp duty that you'd
Huge.
pay. And then there's an additional fee. So it's quite an expensive exercise if you're buying as a non-resident. So what I would recommend if you're in that circumstance is go onto the website, the government frb.gov.au, have a look at the exemptions and read up about that. So that's on the ownership. On the mortgage, so there's a couple of things to consider. Obviously, as part of responsible lending, you have to show a benefit, and this is really a hot topic, a benefit for being on the mortgage. So if you're on a loan, what's the benefit? Now, if you're living in a property and it's in one person's name and you're in a spousal relationship and you're both on the mortgage, well, you can demonstrate there's a benefit because you're taking the benefit of living in the property. If you're buying as an investment property, you have to consider, okay, are you both on the title? So you're both getting a benefit and asset ownership. But from a financing point of view, this can be a little bit tricky because a lot of the lenders I deal with will, because it's an expat policy, they will consider a non-resident as a non-resident loan. So a lot of the lenders do not lend currently to non-residents. So it kind of falls outside the expat policy. So if you need the income of the non-resident for servicing purposes, then we might need to go down the pathway of potentially of what we call non-resident lending. So yes, I've still got lenders that will do it. It's not at the same investment rates that we can get for an expat. So there's a bit of a difference there. What you can look at doing is, can we get the loan to service just on the Australian expats income alone and make some exemptions around, yes, the foreign national work so they can take care of their own expenses. So we're essentially discounting the expenses for that overall application. So it can be a little bit tricky, but first point, the easiest, I guess, least resistance would be trying to get the loan to service just on the expat's income.
Yeah, okay. And I mean, this is sort of a bit of a curly one that I thought I'd throw in there. You know, if I'm not purchasing and my intention is to move back to Australia, but or move to Australia, I'm emigrating to Australia, I'm a foreign citizen, is there a way that I can actually purchase a future main residence? You know, I've got no sort of history there. I'm sort of in the process of getting a tax file number. Is that a similar case where I'd have to go online, check out FIRB, see what kind of exemptions would apply and see whether they'd be happy servicing me?
So would this be moving back with an Australian citizen, you'd say?
No, this is purely just a foreign citizen. So, you know, say a US citizen moving to Australia, they want to buy a property. You know, is it likely that they'll be able to get a loan here in Australia, or probably not?
Yeah, it's a good question. So I guess a good point to make is obviously the lenders will look at, are you a resident or not? Basically, the test is, do you have an Australian passport or citizenship? Now, if you don't, the next level down is obviously a visa, a temporary or a permanent visa. What's the visa you have? Now, if you're not physically in Australia and you don't have an Australian passport, so you're a non-citizen, you're going to, from a lending point of view, you'll fall under as a non-resident lending. You potentially can get a loan. You're just going to have to pay a higher rate and fees. So you're probably better off in that circumstance to wait till you're actually physically in Australia.
In Australia,
we can present to the broker, okay, or the bank, we've got this type of visa, and provided the visa that they have is, you know, sort of a medium or a permanent visa, shows your intention to be living in Australia long term. It's not a temporary visa. Then you should be able to classify under normal lending laws.
Okay. No, that's an important consideration. You've given us a good rundown there. As we progress forward again, next slide, it's huge. It's a big important factor that expats need to be aware of, and it's, you know, foreign currency risks, or as we'll put the FX risks. So you've mentioned it previously already when you engage a provider, and I just want to sort of flesh that out a bit. You know, how does FX risk play into getting a mortgage? And I suppose, is there a situation where a lender, you know, if they know that you're in the US and the US dollar starts to go backwards and, you know, Australian dollar goes back up to, say, you know, 80, 90, 95 cents, who knows, how can that play into this? If I've already got a mortgage or I'm getting a mortgage, what are those sort of factors that they think about?
So good question. So I guess the first thing is the repayments of the mortgage
Yes.
will always be coming from an Australian bank account. So if we get you a loan with lender A, unless you've got an established bank account in Australia that you want the direct debits, let's say you're making monthly repayments on the mortgage, it will come from that bank account. Otherwise, if we're establishing a new Australian bank account with that lender, you'll have the mortgage, the loan, plus the bank account. So the repayments are always going to come out of an Australian bank account, and depending on what you nominate, it's going to be maybe on the 15th every month, and that's the repayment for $1,800 Australian. It's always going to be in Australian dollars, and from a bank point of view, their assumption is that, per the contract, the repayment's going to be in Australian dollars, and it's going to be a fixed amount amortized over 30 years. So regardless of what's happening with FX outside of Australia, they're only really concerned about you making that $1,800 repayment every month in Australian dollars. So some things to consider is obviously looking at an offset account would be one tool you could think about, and that is, if you have funds overseas and you can wait for let's just say the Australian dollar's weak and you're in the US, you've got US dollars, the AUD's dropped, you might say, okay, now's the time to move funds across at the spot rate at that date and park those funds in your offset account. So the offset account is going to reduce the interest charge on your mortgage, and at least that way you've locked in essentially that FX at that date of transference to Australia. The next thing to consider is maybe looking at a fixed loan where you're locking in the interest rate. So you have one variable that's not going to move, and then you understand that that's going to be my monthly repayment for the next 2-3 years, and that's not going to change. The only thing you need to think about is the FX over that period. In terms of how the banks would view it, well, that comes back to when they assessing the application, doing that 20% discount. That's them doing a bit of a risk and saying, okay, if there's movement overseas, we can at least factor that in when we're assessing can they afford the loan up front.
Yeah, okay. No, that's a good clean layout, and I think, forward-looking, I suppose one thing that could sort of change the way the currency goes at the moment, especially talking about the US dollar, obviously you got the Trump trade war and then the election next year as well on the US side, so it's going to be interesting to see what happens there. And then that last point that I sort of put in there is hedging, and I suppose that sort of refers to maybe potentially locking in a forward rate with a currency platform. I'm not sure how long you can lock those rates in. I'm not sure if you've ever come across that, how long you can usually sort of put them through.
Yeah, look, all I know is, and this is outside of my scope, but I just know the longer the contract, the more expensive the premium's going to be. So it's just something you have to weigh up in terms of, are you happy to take the risk of a future FX movement versus the cost of entering the contract? Yeah,
okay. No, and I mean, common platforms that we hear of people using, OFX, TransferWise, TorFX, World First, I think, is a big one as well. So those are some of the things that use. Obviously, when we're doing bank-to-bank transfers, we usually get not the best rate, and we incur some transaction fees as well, which is never nice. Moving forward, obviously this is pretty important, but I think this is more so one that applies to you as a broker and you doing the right thing by your client, trying to find that right mortgage and the options product recommendation. So a lender policy. So, what is meant by a lender policy? Just sort of give us a bit of rundown. Everyone's different, obviously.
Correct. Yeah. So look, it's a fluid, lender policies are fluid. They're changing weekly. I'm getting updated emails from 35 different lenders saying, we're doing this, we're not doing this, we're making this harder, we're making this part easier. A lot of that doesn't really impact expats because they're always under a harder scrutiny in terms of their policy. But it's really how the bank, that in particular bank, will treat that expat and their customer profile. So to give you an example, I won't mention the name, but I had a lender that was, a mid-tier lender about 18 months ago. They just sent out an email to us saying, we're no longer dealing in foreign currency. So they just completely removed themselves out of the market altogether. So that's kind of what we mean by lender policy and just how they treat that. And what I'll talk about in a second is how lender policy impacts securities and locations as well.
Yeah. Okay. I mean that example I think you mentioned. I remember you telling me. I think as a person that was in Dubai, they won 200,000 plus US dollar equivalent and one lender was happy saying that, yeah, well, listen, based on your assets, based on your income, we can lend you approximately 2.1 million. And then another lender said, oh, actually, we're only comfortable lending 1.1. So a huge difference there. And it just goes to show, depending on the lenders.
Correct. Yes. Yep. And I think that came down to one wanted to, again, use Australian tax rates for servicing. The other was happy to look at their tax-free income.
Yeah, okay. I mean, you mentioned location security type just before then, and what do you mean by that from a bank's point of view when they're, considering lending to someone?
Sure. So there's two, and this is where it gets a little bit tricky because we might get a client pre-approved. Let's say, going back to our example of a $500,000 property they're looking for. But the second thing to think about is location security. So this has been really under the microscope with all lenders. They're looking at their internal book, what they've currently got in terms of stock on their loan book. And number one, they don't want to have too much exposure to location, so postcode. So in a highly dense area, so maybe it's the CBD of New South Wales or Sydney, they might say, okay, we're happy to lend you an 80% for a $500,000 property, but because of the postcode, we're only going to do 60% because we want to reduce our risk appetite within that area. So small apartments, something under 40 square meters can cause issues. And even on the other spectrum might be, a larger homestead or a small farm, because I do see a lot of expats, they've had their time overseas, they've grown up in New South Wales, Queensland, Victoria, and they do like the idea of that sort of sea change or going out to the country, having a nice little homestead, a little bit of a farm. They can be quite tricky to get financing. Lenders will categorise them and say, just due to their population, due to where it's located, there's not enough turnover, so we actually won't lend against that type of security, or we'll only do a 50%. So if that's something that you're looking at, you have to be prepared that, yes, you could afford the loan, but the lenders are not going to actually provide the funding because of the security that you're actually looking at.
Yeah, okay. And I imagine that location and security, I mean, that'd be a big issue, and it's probably been a big issue probably for the last 18 months. You look at a lot of the major CBDs, there's been negative double-digit returns reported, and I suppose when you consider a loan-to-value ratio point of view from a bank's point of view, they don't want to, they might have already been over sort of leveraged in that particular suburb, and that's why they're like, too much risk, we're not going to do it.
Yes, and so what I would say is, once we've done a credit assessment, is let me know, number one, what's the type of property you're looking at and the postcodes or the area you're looking at, because a lot of people have no idea where they want to buy, and sometimes people have a very specific idea, okay, I want to buy in these certain postcodes. What I can do as part of the research is a lot of lenders allow you to do like a postcode lookup and see, do they have any specific restrictions on that area? So I can also do that as part of my research.
Okay, no, that's great, especially considering that, as you said, pre-approvals first, then you find the property. As part of pre-approval, you can say, where are you looking? What suburb?
Correct.
Let's have a look.
Yep.
Based on what you can borrow, this is what you're sort of open to, but that lender's not going to touch you in that sort of scenario. So that's really handy. That's good to know. Moving on, number 7. Listen, I'll be honest, I was shocked that we had these in Australia. I know we had some sort of score, but it's not like we're living in the US now. But credit score. Tell me a bit more about these, because they must be recent. They must have brought them in recently.
Yeah, so it's called comprehensive credit reporting, which just came out just recently, and all the big four have signed on, and I believe it was October this year, the second part of their data. So if you go and run your credit score today, tomorrow, you'll be able to see 24 months history of credit facilities, and it'll have a series of numbers and letters. So it will tell the lender, okay, here's a credit card you've had open for the last 4 years. Here's the monthly reporting on the last 24 months, and it'll tell you if you were overdue on time. So what it's doing now is it's giving lenders a better sort of history, like a bigger resume of the potential borrower to see what they like with their credit. And so it's really important to understand where you sit in terms of credit score, and there's plenty of services out there you can use for free. NAB this week just launched a really cool tool. You have to be based in Australia. I was reading the terms and conditions, but you can go on there and sign up for an account, and it'll show you your credit score and actually how to improve it. But just things to keep in mind is, obviously, if you've been overseas for a while, run the credit just to see what the score is, and if there's anything outstanding. Was there a telephone bill from 5 years ago that you just thought, oh, don't worry about it, and now it's on your credit file, that will
Yeah.
be an issue. That will be an issue.
Yeah,
So
okay.
you're better off kind of addressing those issues before you actually going towards the application.
Yeah. This might be a question, you might not be able to answer it because it might be a bit out of your scope, but do you know what kind of things do get recorded on the credit score? Like, obviously paying bills on time, that's pretty crucial. Repayments on mortgages and credit cards, again, pretty crucial. What about someone missing, a rent payment or, something ad hoc like that?
No, so look, I don't think rent's recorded, but every time you make an inquiry for your credit, so it could be a mortgage, it could be a credit card, car loan, that specific financier will make an inquiry, provide you signed a privacy declaration. So that will show up and that will have a history of how many inquiries you've made. So sometimes we see, a person's going for a mortgage and they've made 15 inquiries for that type of finance over the last 8 months. That will actually impact their score. And depending on the lender that they're going with, some will have an internal algorithm where they'll go, okay, if it's under this score and there's a bunch of other factors, we'll automatically decline that application. They might be a good borrower, but because they've made all those inquiries. Other things, credit cards, personal loans, car loans, payday lending, where we're inquiring about finance will be on there. And again, if you've had outstanding rates notices or telephone bills or utilities, that can get put on there if they've been chasing you up and they've then passed on that case to a collection agency.
Yeah, I mean, I think that's a really big one, the credit score. Obviously, a lot of people wouldn't think about that. I didn't even know we had those sort of things. I know, obviously, lenders, they can request your previous history, but I didn't think we had an actual score. So it'd be interesting reading up on that and how that's interpreted, especially from the lenders. But that's an important point you make, and I guarantee that most expats won't be aware of that. Some of them might not even have it, just because it's only just been brought in, moving to that sort of US system. But that's interesting. Moving on, let's talk about number 8, offset versus a redraw. Now, this is a question I get a lot from a lot of clients whenever I'm discussing their circumstances about cash, investable assets, where their mortgages are. It's always receiving some sort of information and then going back and sort of educating them on the difference. So I just would love if you could give me a bit of a rundown of the difference between an offset and a redraw facility.
Yeah, sure. So I guess to think about an offset account, imagine it just as a bank account. It's got a BSB, it's got an account number, so it will sit separately from the loan. Depending on, most lenders will allow what you call fully transactional, so you can log on to your internet banking. You'll have a debit card to access it. So if you're in Australia and you go to the ATM and that's with the bank, you can take cash out, you can get pay come into it, be pay out of it. So it's fully transactional. And the idea around that is if you've got, let's say you've got a mortgage with that lender for 500,000, but you've got $50,000 Australian sitting in the offset account, the interest charged will be on the net borrowing, so the 450, because that's linked against the account. So when you log on to your internet banking, you'll have your loan and then you'll have your offset account underneath. And so that's something that's, for an expat, something that's a really valuable tool, because obviously that will receipt your foreign transactions in, so your money coming from abroad. And you can then also, when you actually come back to Australia, obviously you can use it for other uses as well. It's quarantined from the loan, so that's quite important. Now, when you're talking about a redraw facility, this is when let's say it's a $400,000 loan, the repayments over 30 years, because that's a general amortization on the loan contract, it's $2,000 a month repayments, but you've been a good saver and you're repaying $3,000 a month. So what you'll do over time is build up your redraw facility. So if you were to log into your bank and you look at the loan, you might have balance of 360, and then you might have a number next to it. It might be called balance available or redraw available, depending on the lender, how they actually label it, of $10,000. So what they're saying, the lender's saying, you can go in and redraw the $10,000 against against that loan because you're ahead of your payments. So you've built up a little bit of a credit account against them. So that's the difference. If you want to figure out which product you had, a redraw facility is going to be part of the loan. So you'll only have one bank account. Correct. And which one's preferred and why? Well, I guess it would come down to their circumstances. But if they want to use the funds for private use or for tax use down the track, you really want to keep it in an offset account versus a redraw, because then you can sort of muddy up the two accounts.
Yeah, absolutely. I think that's a big important one. Too often do I see that expats, they have they thought it was an offset account, but it's actually just a redraw account. And I say to them, well, technically you can pull those funds out, but if you pull those funds out, technically you can't really claim the interest expense increase because it's just pulling it from the balance, and it just means you're ahead of your payments. You compare that to an offset account. Because an offset account is a separate account, you've got the original balance of the loan there. If you pull the funds out of the offset account, the interest expense goes back up, but it's still a tax deduction against that investment, which is really beneficial from a non-resident point of view. So whenever considering an offset versus a redraw, consider your circumstances, and obviously, again, speak to a specialist that has an understanding of I suppose your particular niche that you're in, expats. So that's really important. So thanks for that. I suppose moving forward onto bank valuations, number 9, a big one and pretty important, because I've seen clients go through this before as well, and how it can be treated differently on multiple sides. So I guess if you can give us a bit of an understanding of how may a valuation from multiple parties impact an expat gaining a mortgage.
Yeah, sure. So with a bank valuation, there's really there's three general valuations. There's your AVM, which is your automated val, which could be, if an expat's looking just to do a dollar for dollar refinance, we can save them some money. We can do an AVM, which is us going in on the computer, running the back end data, and that will pull out like-for-like sales within the area of a similar stock, and that will return a automated valuation. Now, depending on the LVR and the total borrowings versus that security, that might be enough to get the application through to formal approval, because we can go, okay, yes, the valuation came at 500,000. The LVR for the refinance is 50%. That's fine. Off we go. The other one's called a curbside valuation, which is where a value will go out and drive by the location and make sure that the security's there, it's freestanding, it's per the contract, and they'll return a valuation which is generally in line with the contract of sale. And then the third is a full valuation, where the value will go out to the property. They'll take pictures of the inside and outside. They'll do a full report. They'll pull up 3 like-for-like sales within the area, and then they'll come back and return a value based on their appraised opinion. Now, what I would say about that, yes, we're seeing, particularly around apartments that are just coming onto the market, but you can see shortfall valuations. So that might mean, you've signed a contract for $500,000, the valuation's been done, the value has come back and said it's worth 480. So that's where you get a shortfall, and that means the bank is only going to lend on the 480 value. So the client's going to have to come up with the shortfall in funds to ensure that it will actually settle. The other option can be and I guess this is really important to note, it's not the bank going out and doing the valuation. They are basically subcontracting a valuation company that's local to that security area. It's just their opinion. Now, I don't want to sort of cross off any valuers, but that is their opinion of what that property is worth. We can, as a broker, we can go and engage in another valuer for another bank from a different company, and we can get them to go out there and say, okay, you go out there and value what you think the property is worth. Quite often, because it's 2 human beings doing 2 reports, the results are going to be different. And that could be for a number of reasons. And I guess the third thing to consider is, if that's completely out of line, we have seen, and it's very hard, but a broker can challenge it and say, okay, you've come back and you said the property's worth 480, but here's 3 like-for-like sales that are similar in size. So it might be a 3 or 4 bedroom, 2 bathroom, similar land size. They've been sold in the last sort of 3-6 months. We actually believe it's worth $500,000. And sometimes the valuer will take that on board and go, actually, no, we see where you're coming from. We'll revise that to $500,000, and then the bank can accept that from a valuation point of view.
So I guess, a summary from that is that even sometimes when you get an unfavourable valuation, whether you're refinancing your current property or looking to purchase a new one, it can pay to invest maybe a few $100s in getting that other valuation.
Yeah, so with that, we've got some tools. So first, I've got RP Data, which is a professional login. And so what I'd like to do is, okay, what's the address? I'll run a report. if it's in an area where there's a lot of sales, it can be quite an accurate number that gets returned. So we can do that up front and go, okay, where are we sitting in terms of LVR for refinance? To kind of understand, is there actually a deal there? Because if I do a RP data report and you've only got 10% equity in that property, we're probably not going to be able to help you with a refinance. It's going to be more, we can go and order some valuations, but it might be a bit of a time-wasting exercise for everyone.
Yep. Yeah, of course. I mean, and I suppose that last point I've put there, we've actually already talked about this one, about security type having an impact here, especially where the lenders are willing to, lend on that suburb, lend on that farm, and, valuations, whilst they might come back favourably, the lender seems to maybe see there's inherent risks associated with that farm or that suburb and still only lend.
And just further on that, it's not just the policy, it can also be the credit assessor that picks up the valuation report. So I had a client where their property they had a jetty, and the credit team said, look, just because of that, we don't think that that's something that could get resold as quickly on the market. So we're actually going to reduce how much we can lend against that security. The valuation stacked up with what the contract said, but just because they felt that was a risk factor, they reduced the LVR. They could lend by another 10%.
Yeah. Okay. Wow. 10%. That's huge. Okay. No, that's really interesting. With bank valuations, do you find that they can be conservative? They apply maybe a 5% margin of decline in error there. So, compared to what you might think it is worth on, say, realestate.com.
Yeah. Look, I think sometimes when you're looking at your realestate.com, it is a lead generation tool. So just got to keep that in mind that they might be telling you it's a higher value to get you to maybe engage with them. So that's something you just need to be mindful of. But in saying that, the valuers are meant to be independent. So the banks, they've got a variety of banks that they'll do the valuations for. So really, they shouldn't be under any obligation to have a lower valuation. But in saying that, potentially that could happen. We don't know what happens behind the scenes.
Yeah, that's right. Okay. Well, the last item that I want to touch base on today, number 10, purpose of property purchase and whether, this has an impact on whether a lender is going to give us those funds. So, as we can see here, I'll put a few points, the purpose of the property purchase, either for a main residence, investment, knockdown, rebuild. Can these factors hinder us as expats to obtain a mortgage?
Yep. So the first one, the way you present it comes down to your current financial circumstances and then what sort of within the next 12 months, what you're going to be doing. If your intention is to purchase and then move in. So obviously the bank are really concerned about, okay, well, if we're trying to assess on overseas income, well, what's your job income going to be when you move back to Australia? Because are you going to take that same role and going to be able to work from that? Let's say you're moving to Sydney. Okay, show us some sort of correspondence to give the bank comfort around that type of scenario. With the second one, investment, so that's fine in terms of purchasing. There's two things we just need to consider is obviously the rental income coming off that Australian purchase we can use. So that will come off the valuation report or perhaps an appraisal from a real estate agent saying, yes, this property is currently tenanted, it's getting $400 rent a week. We can use that for income purposes. The banks, again, will take the gross rental income and will shade it down to 70-80%. And that's really just on their end being conservative and taking into factors like vacancies and some of the ongoing management fees that you'll pay the real estate agent, and they'll just take it and the net for servicing. The third one, quite tricky, to be honest. Even if someone's based in Australia, what you're seeing is to go through a build, and particularly if you're not buying a house and land package through, a registered builder and you're going down that pathway with a fixed build contract. But if you've got a property existing in, somewhere out of Sydney and it's got an older house and you want to knock it down, put a new house on it and go through that process. To get funding, it's extremely difficult just to kind of set expectations because the lender is really concerned about their security. So if something happened halfway through a build and that lender's got security on that title, it's not really great for them to resell on the market. So what we've been looking at with a few scenarios is, okay, if the client has another property So
Mhm.
they've got two properties and they've got equity on the separate property, cashing out against that property and using those funds, and they control the build. So instead of going down the pathway of fixed build contract where you make progress payments to the builder, you have, let's say you've cashed out $300,000 and you pop those funds into account, and once you've done the stage of the builder, you pay the invoices as you go. That way you've got, the bank's happy because they've got an actual existing security that if anything went wrong and they needed recourse on that property, it's already built. You're not rebuilding it, and then you're left with the unencumbered property, which you're halfway through a build. So you're kind of wearing the risk.
Yeah, okay. That's interesting. I mean, I know some clients, they do have that sort of intention that they bought a property, they'll treat it as an investment property for the time, and then they know eventually either when they return back to Australia, they'll look at potentially refinancing to get, I think, a construction loan, and then go down the process of sort of redeveloping it. A common thing that people do these days is build a duplex or, townhouses and try and make that additional profit, which is risky in itself. So, that's very interesting to get that sort of insight into it. So that's good. But let's move forward. So just going to head over to the next slide. We are going to do questions. Got quite a few that I want to run through, but we're going to actually do it on our Aussie Expat podcast. So that'll be up on a separate link, and we'll include the links, obviously, underneath this this YouTube video that will eventually go up there. And then lastly, just touching on our contact details if you have any questions. So firstly, Jeremy Harper's, best contact details, jeremy@hfinance.com.au. Or I believe you can book in a consult with him. Is that right, on your website?
That's right, yes. There's a contact button, and there's also some contact forms down below, and there's an expat landing page I can read about.
Yep, okay, amazing. So as you can see there, www.hfinance.com.au, pretty clear. And then lastly, obviously, our contact details, any questions, queries, info@atlaswealth.com, or visit our website for more information, www.atlaswealth.com. Okay, guys, well, thanks for your time today. Obviously, as I said, we're going to be answering some questions very shortly on our Aussie Expat podcast. Head over there to listen more, and thanks for your time.
Perfect. Thanks, James.
No worries, mate. Thank you.